Imagine you just pulled off the perfect crime. Congratulations. You're sitting in a room surrounded by more cash than most people see in a lifetime. Stacks of it. Bags of it. Maybe you've even done the thing where you throw a bunch into the air and let it rain down on you. That part was fun. Here's the part that isn't. You can't do anything with it. Not buy a house, not a car, not a vacation. Not even a suspiciously nice watch. Because the second you try to spend any serious amount of money, someone is going to ask the one question you really don't want to answer. Where did all this come from? And I worked really hard is only going to fly for so long before someone starts doing the math. That's the criminal's fundamental problem. It's not getting the money. It's making the money look normal. And the system they built to solve that problem is, depending on how you feel about brazen financial engineering, either genuinely impressive or deeply unsettling. Probably both. We're talking about money laundering. Somewhere between $800 billion and $2 trillion cycles through this process every single year globally. That number is so large it's almost hard to hold in your head. For reference, that's roughly 2% of the entire world's economic output, quietly cycling through fake companies, offshore accounts, luxury condos, and surprisingly expensive paintings every year. So let's actually break down how this whole machine works, because it's more structured than you might think. First, what even counts as dirty money? Before you can understand why anyone needs to launder anything, you need to understand what makes money dirty in the first place. It's simple, really. Dirty money is cash that came from something illegal. Drug trafficking, human trafficking, fraud, extortion, bribery, corruption, tax evasion at a spectacular scale. Whatever the source is, the state took no percentage from it, and the person holding the cash has a very strong interest in making sure the government never finds out it exists. The problem is that money, by its nature, leaves traces. Every deposit, every transfer, every large purchase creates a record. Banks log it, governments track it, and if the numbers don't add up to a life that makes sense on paper, investigators start asking uncomfortable questions. So the goal of laundering is pretty elegant, in a criminal sort of way. You take money that essentially has a sign on it saying, "I came from somewhere illegal, please investigate," and you run it through a process that makes it come out the other side looking completely legitimate. Normal income, normal profits. Money you can actually spend without anyone raising an eyebrow. The transformation from dirty to clean is what the whole operation is about. And the process criminals have refined over decades to do this runs in 3 distinct stages. Each stage has its own risks, its own tricks, and its own specific ways things can go spectacularly wrong. Stage 1 is placement. Stage 2 is layering. Stage 3 is integration. Let's go through each one. Stage 1, placement. This is the part where most criminals get caught. You've got physical cash, actual paper bills, maybe a lot of them, and you need to move that cash into the legitimate financial system without triggering every alarm that the banking industry has specifically built to stop you from doing exactly that. Think about what that looks like in practice. You can't just walk into your local bank branch with a gym bag full of $100 bills and ask to open a savings account. The teller is going to have questions. The bank manager is going to have questions. And within about 48 hours, a federal financial crimes unit is also going to have questions. So getting cash into the system quietly requires creativity, patience, and a willingness to do a lot of very tedious work. One of the most well-known methods is called structuring, though most people know it by its street name, smurfing. The name is a little absurd. Yes, like the cartoon. No, nobody seems to know exactly why it's stuck. Smurfing is when you take your massive pile of cash and break it into dozens or even hundreds of smaller deposits. Each one is carefully kept just below the threshold that triggers automatic reporting to financial authorities. In the United States, that threshold is $10,000. So your deposits look like $9,700 here, $9,400 there, $9,850 somewhere else, spread across different banks, different branches, different days, sometimes different cities. By itself, no single deposit looks suspicious. That's exactly the point. The truly committed operations don't even do the depositing themselves. They hire people specifically for this job. Those people are the smurfs. Their whole role is to physically travel from bank to bank, account to account, making deposits that stay just under the radar. It's not glamorous work. You're essentially doing the world's most anxiety-inducing errand run, over and over, for weeks. But it works. At least, it works until it doesn't. Banks have gotten pretty good at spotting patterns. Structuring is actually illegal on its own in most countries, even if the money itself was clean. So even the workaround has a workaround problem, which is why a lot of operators move on to method 2. Cash-intensive businesses are one of the cleanest placement tools available, and they've been used for decades. The concept is straightforward. You find or start a business that handles a lot of cash transactions by its very nature. Restaurants, car washes, laundromats, nightclubs, hair salons, parking lots. These businesses take in cash constantly, and it's genuinely difficult for anyone on the outside to verify exactly how much real revenue they're generating on any given day. So you take your dirty cash, blend it into the business's reported income, inflate the numbers a bit, and deposit everything together as normal business earnings. On paper, you're running a very popular car wash. In reality, you're cleaning money at the same time as the cars. The sophistication of these setups varies enormously. Some are small scale, one business, one city, barely moving a few $100,000 a year. Others are entire networks of businesses operating across multiple countries with professional accountants keeping the books looking immaculate. There are documented cases of laundromats that reported more customers in a single week than physically existed in the surrounding neighborhood. Nobody caught it for years. The sheer volume of cash that moves through legitimate small businesses makes individual scrutiny almost impossible at scale. And that's before you get into digital payment manipulation, fake invoices, and over-reporting sales figures in ways that are incredibly difficult to audit. Stage 2. Layering. Okay, the money is in the system. It's sitting in a bank account somewhere. No longer cash, no longer screaming, "I came from a crime." But it's still traceable. If investigators look hard enough, they can still follow the trail back to its origin. That's where layering comes in. Layering is the art of making that trail so complicated, so tangled, so spread across so many institutions, in so many different countries, that by the time anyone tries to follow it, the thread just disappears. You're not hiding the money. You're hiding the path. And the more turns you put in that path, the better. A basic layering sequence might go something like this. You wire money from an account in one country to a shell company registered in a second country. That company loans the funds to a separate entity in a third country. That entity uses it to make an investment in a fourth country, which generates returns that get sent back to a personal account in the first country. 5 or 6 moves like this, all going through different legal jurisdictions with different reporting requirements and different levels of financial transparency, and even a seasoned investigator is staring at a wall. Each step is individually legal looking. The problem is only visible if you can see the entire chain at once, which is exactly what the system is designed to prevent. Shell companies are the engine that makes layering work. A shell company is a corporate entity that exists entirely on paper. It's registered, it has a name, it has a bank account, and that's basically it. No employees showing up to work. No actual products being made or sold. No office you could visit, just a legal entity that can hold money, make transactions, and obscure who actually controls it. And the wild thing is that creating one of these is completely legal in a lot of places, and it's genuinely cheap. In certain jurisdictions, you can have a shell company up and running for a few $100s. No one asking too many questions. No public record of the real owner's name. The jurisdictions most commonly associated with this are exactly the ones you'd expect. The British Virgin Islands, the Cayman Islands, Panama, Luxembourg. But here's the one that always surprises people: Delaware. Right there in the United States, a perfectly ordinary looking state, best known for corporate-friendly tax laws and not much else. Delaware allows companies to be formed with minimal disclosure requirements, and for decades it has been one of the most popular places on earth to register an anonymous corporate entity. You don't have to be a shadowy international crime operation to use it, but it certainly helps if you are. So here's what investigators actually run into when they try to trace laundered money through a shell company network. They find a company registered in one country. That company is owned by a holding company in a second country. That holding company is managed by a trust in a third country. That trust is administered by a law firm in a fourth country, and that law firm is bound by attorney-client privilege and the strict bank secrecy laws of wherever they're located. Congratulations, you've reached a dead end, and you got there completely legally. Every single layer of that structure can be entirely compliant with local law. That's not a flaw in the system. That's the feature. Stage 3, integration. This is where the line is crossed. Your money has been placed into the financial system. It's been layered so thoroughly that its origins are practically untraceable. Now comes the final step, getting it back into your hands in a form you can actually use. Integration is when laundered money re-enters the legitimate economy in a way that looks completely clean. It comes back as profits from investments, proceeds from property sales, returns from business ventures. On paper, it looks like ordinary wealth. In reality, it's the same money from the beginning, just scrubbed. Real estate is one of the most popular integration tools in the world. The mechanics are almost elegant. You buy a luxury property through one of your shell companies, a high-end apartment in a major city, a beach villa, a commercial building somewhere central. You hold it for a year or two, then you sell it. The proceeds from that sale are now completely documented as real estate profits. Clean money, ready to spend. No one is checking whether the buyer was a legitimate investor or tracing exactly where the purchase funds originated. And in many cities, particularly London, Miami, Vancouver, and Dubai, high-end real estate has historically been a largely anonymous transaction. Entire apartment blocks full of units that nobody actually lives in, all owned by companies that don't seem to have any real people behind them. The art market is another favorite, and it's particularly useful because it operates with almost no oversight at all. A painting changes hands for $40 million. There's no independent body certifying what it was actually worth. There's no requirement to disclose who's buying or selling. The price is whatever two parties agree it is. So you buy a piece through an intermediary, hold it, and sell it later. The profit is now art investment income. Legitimate, documented, impossible to challenge. The art world has acknowledged for years that it has a money laundering problem. Not a lot has changed. The opacity is sort of the point of the whole thing, whether you're laundering money or just preferring not to have your collection publicly cataloged. Casinos have been used for integration as well, and the method there is almost comically simple. You walk in with dirty cash, convert it to chips, gamble a little, then cash out. The casino gives you a receipt. You've now got documented gambling winnings. Some operations take this further by actually winning real money at the casino and intermixing it with the conversion so the records look even cleaner. Sports betting has emerged as a newer version of the same idea, particularly online platforms operating across multiple jurisdictions where reporting requirements are still being worked out by regulators who are perpetually about 2 steps behind the people they're trying to regulate. Cryptocurrency has added a genuinely new layer of complexity to this entire picture. The original pitch around certain cryptocurrencies was that they allowed transactions to happen outside the traditional banking system with a degree of anonymity that didn't exist before. In practice, most major cryptocurrencies leave a public ledger of every transaction that ever happened. That's not as anonymous as it sounds. But the ecosystem of crypto mixers, privacy coins, and decentralized exchanges has created tools that are explicitly designed to obscure where funds are coming from and going to. Regulators are working hard to close those gaps. The people using those gaps are working equally hard to stay ahead. It's an ongoing race where the finish line keeps moving. Now let's put some real numbers on all of this because the scale is genuinely staggering. The United Nations Office on Drugs and Crime estimates that somewhere between $800 billion and $2 trillion flows through this entire process every year globally. That range is wide because by definition, this is money people are trying very hard to hide, which makes accurate counting basically impossible. But even the low end of that estimate is nearly $1 trillion. That's the economic output of entire countries, cycling through fake businesses, offshore accounts, shell companies, real estate deals, and art auctions, every single year without governments getting their hands on most of it. The enforcement picture is, depending on how you feel about it, either completely understandable given the complexity or genuinely depressing. Of all the money laundered globally in a given year, investigators and law enforcement agencies worldwide successfully identify and seize somewhere around 1% of it. 1%. The other 99% makes it through the entire process, comes out clean on the other side, and gets spent on whatever the people running these systems want to spend it on. Governments have poured enormous resources into financial intelligence units, anti-money laundering regulations, international cooperation agreements, and reporting requirements for banks. And the result is a 1% interception rate. Part of the reason enforcement is so hard is structural. Money laundering by nature crosses borders, and law enforcement doesn't. A criminal operation that runs through accounts in 6 different countries requires cooperation between 6 different legal systems, 6 different sets of regulators, 6 different governments, all moving at the same time in the same direction. That coordination exists, but it's slow, it's bureaucratic, and the people being investigated are usually moving much faster than the people doing the investigating. Financial criminals aren't usually running from anyone. They're sitting in nice offices filing legal paperwork. The whole system looks like a business because functionally it is one. Banks themselves are theoretically the front line of defense. They're required to have anti-money laundering compliance programs, to file suspicious activity reports, to know who their customers are. And most of them take that seriously, at least officially. But the sheer volume of transactions flowing through large global banks on any given day is so enormous that genuine scrutiny of every account is impossible. Some of the biggest banks in the world have paid billions in fines over the last 2 decades for failures in exactly this area. HSBC paid nearly $2 billion in 2012 over money laundering failures. Deutsche Bank paid $630 million in 2017. Standard Chartered, Wachovia, ING, the list goes on. The fines are significant. They're also, in a lot of cases, smaller than the fees the banks collected for the transactions in question. The regulatory response has picked up considerably in recent years. Beneficial ownership registries, which require companies to publicly disclose who actually owns them, have been introduced or are being introduced in a growing number of countries. The United States passed the Corporate Transparency Act in 2021, which began requiring many previously anonymous shell companies to disclose their real owners to federal authorities. Real estate professionals, art dealers, and cryptocurrency exchanges have all been pulled more firmly under anti-money laundering rules in various jurisdictions. The loopholes are getting slightly smaller. New ones keep appearing. The people finding those loopholes are well-funded, well-lawyered, and highly motivated. criminals running a 99% success rate don't tend to panic about regulatory updates. They tend to hire someone to read the update and find the gap. So that's the machine. Placement gets the cash into the system. Layering makes the trail impossible to follow. Integration brings the money back as legitimate income. And at every stage, the techniques are constantly evolving, constantly adapting to whatever new rules get put in place to stop them. The $2 trillion figure isn't a glitch or a gap in the system. It's the output of an entire parallel financial industry that has been quietly running alongside the legitimate one for decades. If any other industry in the world managed to operate at a 99% success rate year after year, we'd put it in business school textbooks. In crime, they just call it Tuesday.